So today we're going to talk about entrepreneurial financing. Essentially what we've done here is we've listed on a continuum all of the different types of financing, or many of the different types of financing that entrepreneurs can go after. The idea being that we wanted to list sort of in order the various places that you can raise money or resources for your company. The order that they're in has to do with how complex of a funding entity you might be seeking out, and what you have to give up, and the terms associated with these sources of money. Not all of these are going to be appropriate for every business, so as an entrepreneur it's really important to understand the differences between these entities, what they want to get from you and from your business, and really how they make a living and how they make money. If you understand that, then you'll do a much better job of targeting the appropriate type of investor or source of investment for your company. So let's start over here on the simple side of the spectrum, and we'll talk through these. The first option, and the simplest option, is your current job. You may have a full-time job, and if that's the case, you may be using the money that you earn from that job to finance your new company, your entrepreneurial company. By the way, I should mention that we'll break out a video that describes each one of these sections in greater detail because there are some variances on how these funding sources work. The second would be your own savings. If you're using money from your savings account. Lots of us don't have any savings, so sometimes that's not an option. You'll notice these are all under the tag of self-financed, meaning you're really coming up with this money yourself. And what drives a self-financed option, like your credit card, for example, that of course has a percentage interest rate associated with it, and your mom, your mom might be nice enough to write you a check, or I say jokingly your Uncle Larry, anyone else in your familial network or friends network that you might be able to call on to sort of blindly write you a check to help you with your business. That happens all the time. Those are self-financed options. What drives self-finance options, I've not so jokingly made a smiley face, meaning these are people who just want to help you. They want to be associated with your business and they want to see you do well in life and otherwise. So with very little sophistication and demanding very little from you, they'll typically write you a check. And so I put a very small dollar sign here, meaning of course they'd like to make money in the long term, but they don't have to in order to participate with you. So this is almost always the first place that people go to finance their company because it has very low expectations and it is an easy source of money. So the second piece would be what we call ecosystem financing. This is a little different. You'll notice I have a giant American flag and a bad drawing of a factory. That's supposed to signify that these guys are generally giving you money or helping you or lending or whatever they're doing in order to fulfill one of two things. Either do something good for the country or for the city or your ecosystem, or to create jobs in some sort of governmental way. These are also very good options, things like business plan competitions. And I put free here, meaning there are lots of things in your area that are going to not require any money for you to enter, like a business plan competition or a university competition that may have 5 or 10 grand as the winnings that you would take home if you won that competition. So that's an option for a lot of entrepreneurs. There's also government grants. If you're doing some new sort of technology that's in favor with the current government administration or your local city or county, they may be giving away money to businesses that are trying to do, people that are energy efficiency ideas and things like that. Then there's what we call incubators and tech transfer offices. This is sort of a bigger subject, which we'll explain in greater detail in another video, but incubators tend to be groups that are, their goal is to help small companies grow and establish themselves. They're often funded by either universities or government entities, which makes them not the classic sort of investor that needs to make a lot of money. They consider a success just helping your company move from one stage to the next. And tech transfer offices are associated with universities. These tend to be at large universities that have lots of ideas coming out of their science or engineering departments, and those offices are tasked with helping the people that own those patents or own those ideas commercialize their ideas. And that may help be legal work, help gathering funding. There's a whole bunch of different resources they may extend in your, including some money. Often they will take an equity position, and we'll talk more about that later. But these are, again, on the spectrum, they're not as good as self-financed because you do sometimes have to give up a little bit of your company, unless of course it's a free business plan competition. But they're also not very onerous in terms of what they expect and how they make money. So we'll move past these guys, which are motivated, by helping you and feeling good about themselves, to sort of government and job creation reasons, and now you get into the money section of the world. So really, when you move from these guys into banking or equity financing venture capital, you really get into more of a money and returns driven world of potential financiers. So let's talk about banking first. Before you might go to an angel or a VC, a lot of entrepreneurs will go borrow money from a bank. They might do this to buy inventory, they'll do it to hire employees or what have you, but that bank is a source of potential financing. The thing to understand about banks, which isn't a big mystery, is that they're driven by taking a small amount of dollars and turning it into a larger amount of dollars. That's the idea behind a loan, of course, and so we call these commercial funding sources. Typically, you'll look at home equity loans, SBA loans, or commercial loans. Home equity loan, of course, is borrowing against the equity in your home. An SBA loan is a small business administration loan that's partially funded by the government in order to grow small businesses. And then commercial loans are just, you're walking into a bank and getting a regular loan for your business. These are kind of in order of how difficult they are to receive, and also in order of how onerous they might be. You might have a lot stricter rules and a higher interest rate on a commercial loan than you would on an SBA loan or a home equity loan. Home equity loans are pretty straightforward. Most people are somewhat familiar with what those are. So this is an option as well, but remember, unlike your family and unlike these ecosystem players, these guys are going to want you to pay them back. In fact, they're going to demand that you pay them back, and they're going to want to make money on that process. And then all the way at the end of the spectrum are angel investors, seed funds, and early stage venture capitalists. This, for some reason, is where a lot of entrepreneurs jump to almost immediately when they start thinking about funding their company. A lot of times they'll skip over all these other options and they'll start to say, I gotta go raise money from a VC or an angel investor. So we'll talk more about these in more detail, but there are only certain types of investments that are even appropriate for these investors. And they are one of many, as you can see, options on the spectrum. So this portion we'll call equity/venture capital. This is all about return for these guys. They are commercial entities that are aggressively trying to make money. They serve a very useful purpose, but they're also trying to make money. It's very important to understand how they make money and under what business model. And really they're driven by an internal rate of return, which is IRR, and straight dollars making money by buying equity in your firm. So these folks tend to have somewhat onerous terms, and they have lots of rules about when you get the money and under what circumstances and how you can use it. So this is really a pretty good introduction into basic entrepreneurial financing. You start with self-finance, the lowest expectations and the lowest commitment from you. Then there's ecosystem sources that are driven by other reasons than money, that also have relatively low expectations and aren't so onerous. And then you start getting into commercial and equity financing, which is really a money and profit-driven enterprise. So hopefully this will give you guys a better idea of the various options for financing your company.